I've had a ton of you point out the recent drop in the reverse repo facility to me lately on Twitter. As we can see here, the reverse repo facility had a peak of about $2.4 trillion on September 30th, and it has significantly fallen off since then on October 4th, sitting around 2.2 trillion. And so a lot of people have pointed out that that may be what is contributing to the drop in yields, the rise in asset prices over the last few days as well. And I'm not so sure. We're going to dive into the detail. I don't think this is the reverse repo bailout that I've been predicting on this channel for a long time. I think that's still to come. Let's get into the details. Ready? Let's dive in. Like I said, a lot of you pointed this out to me on Twitter. Were tagging me in some other creators' posts about the reverse repo facility, the $100-200 billion that has been drained out of the reverse repo facility over the last few days. And I appreciate it. Most of the videos that I make are ideas from you, whether you guys tag me on Twitter. I read your comments. I don't always have time to respond to them all, but at least I read them. I get the questions and I try and make videos about the stuff that you guys are asking me about. So this is one of them here, the reverse repo facility here. We can see that on September 30th, it hit $2.425 trillion. And then it has since dropped. There was a big one from that Friday to that Monday down to 2.52. And then as of Tuesday, $2.233 trillion. So that was a significant drop, obviously, very big drop here. But when in doubt, zoom out. That's always what we have to do to take everything in context. And we can see here that that was preceded by the end of the quarter run up. And that's what happens in the reverse repo facility every single time we have one of these spikes. Look at that. That spike here was in September. It was an end of quarter here. So right here, this giant spike was in June, end of a quarter. This giant spike here was September, end of a quarter. This giant spike here in December, end of the quarter, end of the year. So that's what happens to the reverse repo facility for a number of reasons. That's just the way things work in the banking mechanics, money markets here. So if we don't need to get into that, as long as we understand, hey, every quarter, at the end of the quarter, that's what happens. There's a big spike. A couple days later, it all goes away. The other thing to recognize is if we zoom in a little bit more here, since June of this year, this $2.2 trillion has been the average. It has fluctuated around that level. And so, yes, there was a big spike, but then it dropped off again here back down to the normal level that it's been at this whole entire time. So background on reverse repo facility, just in case you're not aware, this is like one of the pawn shops that the Fed operates with banks. So banks get to the end of their day and they think, they look at their balance sheet, they look at their cash and they say, okay, we've got a lot of collateral, or they say we've got a lot of cash. If a bank says, hey, we've got a lot of cash, they go out and they ask anybody, hey, does anybody need collateral, or anybody need cash? We need collateral, or vice versa. And so they buy and sell with each other, and these are called repo agreements. Repo, it's short for repurchase. And so they all come to these agreements with each other and they say, okay, I'm going to give you the collateral, the treasury, and you give me cash, and then I promise to repurchase it from you at some date in the future. Well, sometimes there's not enough cash or collateral in the system for banks to do that with each other. So over the last couple of years, the Fed has increased the amount that they operate in these markets, and they become the pawn shop for all the other banks themselves. And so the reverse repo facility is where banks or financial institutions go to get collateral. So you've got a lot of money markets operating in here where they've got a lot of cash, and then they go to the reverse repo facility and they say, hey, we need some collateral. And so they give the cash to the Federal Reserve. They get their collateral in return, and they get paid a nice little interest rate while the money sits in there with the Fed completely 100% risk-free. The only counterparty that has a legal monopoly on creating money cannot default, even better than the government. And so over the last couple of years here, year and a half, we've seen the amount of money go in here increase even more and more and more, simply because the interest rate that is being paid on this money keeps on increasing above the Fed funds rate. And a risk-free rate of, 3% right now is a heck of a lot better than having the risk of being in short-term treasuries or even T-bills. And so this $2.2 trillion is sitting in here right now risk-free. You're getting a nice chunk of change on just sitting there. This means that if for one reason or another, the interest rate that's being paid into the reverse repo facility ever changes, and let's say just goes to 2% or 1% or goes down to 0, there would be no incentive to keep that money in there there anymore. All the money markets and financial institutions that got flush with cash from COVID needed to go find collateral to offset those liabilities, because that's the way the banking system works. All that cash, the financial institutions would take that and they'd go out to find collateral from the open market, like buying T-bills. And so when we see cash drain out of here, that is allegedly what that cash is doing. It's going out to the open market instead. And of course, we see a little bit of a correlation there with prices on debt decreasing, or I should say the yields on debt increasing, and we see asset prices increasing. But so far, this just looks like the regular quarterly pattern that we see happen all the time. Nothing out of the ordinary here. I'm watching this repo facility virtually every single day here, and as soon as I see something different, you will be the first to know, I promise. But right now, we are still very much in line with where we've been since June. Now, if we get to under that $2 trillion number here, if this decline continues at this pace and we break the $2 trillion mark, then that could be a big deal. Then there could be some indication that maybe now all that cash is saying, hey, we'd rather get a higher interest rate, even though there's a higher amount of risk on that by going and purchasing something on the open market. And we could see a flood of money come out of the reverse repo facility and go buy assets from the open market. That's definitely possible. I don't think that's happening yet, but we'll know within the next week or so whether that is happening. It just doesn't look to me like there's any evidence of that happening yet. This looks to me like the same pattern that we see every single quarter, and we're still in line with where we've been since June. But if we get enough economic trouble, if we get enough banks starting to fall over in Europe, if we get enough pensions being bailed out by central banks like in the UK, the Bank of England, if we see enough things like that happen, it's very possible the Fed just comes out and says, you know what, we're dropping the interest rate on the reverse repo facility. The market needs some liquidity, the market needs some cash, so we don't have to provide that anymore. We're going to stop doing that service, and then all that cash will float out there, and it'll be a $2 trillion buffer to the global economic system. Massive infusion of liquidity, while the Fed gets to save face and gets to continue to raise rates and sell assets off their balance sheet. So they're basically playing both sides. It's not happening yet. It will happen soon, and when it does, it will be the first sign of the Fed pivoting. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.